Have we stopped laddering T-bills? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. Treasury yields saw a bit of an up and down midweek with a short-lived flight to safety amidst rising tensions between Ukraine and Russia. But they came back quickly and ended the week mostly stable. So, with that in mind, here are the three topics that we'll be covering in today's update video. 1. What's the latest on our TBill ladders? This is a question that quite a few of you have asked me recently, so let's talk a little bit about this. 2. Which treasuries rose and which ones fell this past week? And 3. What are the yield expectations for the upcoming treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. So yes, we are still laddering T-bills, mostly on the shorter end, as we've been doing since 2022, with multiple 4, 8, and 13-week T-bill ladders still running at Fidelity. While the rates on these maturities have come down slightly in recent months with the Fed rate cuts, our T-bill ladders still consistently yield investment rates between 4.5% and 4.6%, depending on the maturity. And given that we live in a high-tax state, the state and local tax exemption on T-bill interest earned in our taxable brokerage accounts means that we still come out ahead with our T-bill ladders versus most money market funds. Plus, Fidelity's auto roll feature means that I basically have my T-bill ladders on set and forget mode. Every time one T-bill matures, Fidelity automatically reinvests my cash into the next one with no lag time in between. And for the time being, we expect to continue parking most of our excess cash in our T-bill ladders as we wait for other investment opportunities. That said, we do still have a few months of emergency savings parked in money market funds. But more on this in a separate video. Stay tuned. What about you? Are you still laddering your T-bills, or have you started dollar cost averaging into your longer dated bond ladders? Or are you buying something else altogether? Drop a comment below and let the community know. And let's move on now to the next section of this video. As we so often do at the end of the week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. The 7-year, 10-year, and 20-year were down by a few basis points. The 2-month, 5-year, and 30-year were unchanged. Otherwise, all the other maturities were up a bit, with the biggest moves seen in the 1-year and 2-year. But it's all relative. Even the 1-year, as the largest mover, went up by 8 basis points only. So, as I said, it was for once a relatively stable week after the volatility that we've seen before and after the election. Yields did go down a bit midweek as Ukraine-Russia tensions intensified and investors flocked to the safety of U.S. Treasuries again, as they so often do when the markets get spooked. But they bounced back mostly at the end of the week due to a more positive outlook on the future direction of the U.S. economy. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields across all maturities 1 year and below are still noticeably lower than where they were at the start of the year. For the first time since July, the 2-year ended up higher than where it started the year. Everything 2-year and longer is now above where they were on January 2nd of this year. The yield curve remained negative and even widened very slightly last week on the extreme ends. The negative difference between the 1-month versus the 30-year stands now at 12 basis points versus 10 basis points last week. Not sure the 2 basis points increase from last week is significant, but in the big picture, this is still quite a change from the 147 basis point difference from the beginning of the year. And the widely used comparison of the 2-year versus the 10-year Treasury, which has been in positive territory for a bit now, has remained there. However, the positive difference narrowed again to 4 basis points from 12 basis points a week ago. This may or may not be significant as an indicator that the yield curve may turn negative again. It's too soon to tell, but we'll definitely keep watching the space here for you at Diamond NestEgg. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. Also on the calendar is this 52-week T-bill, this 41-day CMB, and this 30-day CMB. And if we scroll down further, we can see the 2-year T-notes, the 5-year T-notes, and the 7-year T-notes will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined. Also on the schedule is this 1-year 11-month floating rate note, which is a reopening auction. At the time of this taping, here's what the expected yield is for the 52-week T-bill on Fidelity's platform. And here's what the coupon and the expected yield are for the 2-year T-note. Here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one again from FHLB at 6.25%, with a first call date in February 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds, there is quite a long list to choose from again this week on Fidelity. Here's where the highest yielding new issues stand at the moment. The highest yielding one is also again from Deutsche Bank this week at 6.05%, with a first call date of November 2025. Here's the CUSIP for those of you who may be interested. For brokered CDs, here's where the new issues are currently. Like the last 2 weeks, the highest yielding one is from Jonesboro State Bank at 4.6%, this time with a first call date of March 2025. As I've mentioned in previous weeks, the yields on new issue brokered CDs have been a bit lackluster recently. All right, member super savers and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A today, Sunday, November 24th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be diving deeper into all things fixed income. I've also linked the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.